Most people make this mistake without realizing it. They're short on money, maybe for an emergency, maybe to cover expenses that got out of control, and they're standing in front of two options: a personal loan or a credit card. One feels responsible, the other feels flexible, and they choose the one that feels easier in the moment without understanding the long-term cost. Years later, they're still paying for that decision, sometimes literally. I've seen people carry the consequences of this mistake for 5, 7, even 10 years. And the worst part is, most of them thought they were doing the smart thing. So today we're going to answer a very simple question that almost nobody explains clearly. Personal loan versus credit card. Which one is actually worse? Not emotionally, not what sounds better, but financially, structurally, and long term. And by the end of this video, you'll know exactly which one hurts more, when, and why. Let's start with how most people think about this. A personal loan feels serious. You apply, you get approved, you receive a fixed amount of money, and you make fixed monthly payments. A credit card feels casual. You swipe, you tap, you pay later. No fixed timeline, no clear end. Because of that, people assume credit cards are dangerous and personal loans are safer. But that assumption is only half true. To understand which one is worse, we need to understand how each one actually works, not how they're marketed. A personal loan is an installment loan. That means you borrow a specific amount and you agree to pay it back over a fixed period of time, usually 2 to 5 years. Every month, you pay a fixed amount. Part of that payment goes toward interest and part goes toward the balance. Over time, the balance goes down and eventually the loan is paid off. Simple, predictable, structured. A credit card is revolving credit. There is no fixed payoff date. You can borrow, pay some back, borrow again, and repeat that cycle indefinitely. The bank only requires a minimum payment, which is often very small. As long as you make that minimum payment, the account stays open, and interest continues to accumulate on whatever balance remains. Now, here's where things get interesting. On the surface, credit cards usually have higher interest rates. Personal loans usually have lower rates. So people assume credit cards are worse. But interest rate alone doesn't tell the full story. What really matters is how long the debt stays in your life. Let's use one clear example to make this real. Imagine you need $10,000, maybe for medical bills, maybe to consolidate debt, maybe because life just happened. You have two options. Option one is a personal loan. You get approved for $10,000 at 10% interest for 5 years. Your monthly payment is around $212. Over 5 years, you'll pay about $12,700 total. That means roughly $2,700 in interest. Not great, but manageable. And most importantly, there's an end date. 5 years from now, that debt is gone whether you like it or not, as long as you make the payments. Option two is a credit card. You put $10,000 on a card with a 22% interest rate, which is very common in the US. The minimum payment is around 2% of the balance, roughly $200 at the beginning. Sounds similar to the loan payment, right? But here's the trap. That minimum payment drops as the balance drops, which means you're always paying mostly interest and very little principal. If you only make minimum payments on that credit card, it can take more than 20 years to pay off that $10,000. And the total interest paid can exceed $15,000. And that means you could pay more in interest than the original debt. So which one is worse? Structurally, the credit card is far more dangerous. Not because of the interest rate alone, but because it has no forced ending. It allows debt to linger. It allows procrastination. It allows you to stay stuck. But that doesn't mean personal loans are always the good guy. Personal loans have their own hidden danger. They give people a false sense of resolution. You consolidate credit cards into a personal loan, your cards are suddenly empty, and psychologically, it feels like you fixed the problem. But if the behavior that created the debt doesn't change, people often run those credit cards right back up again. Now they have a loan payment and credit card balances. That's how people go from stress to drowning. So the real question isn't just which one is worse. The real question is which one matches your situation and behavior. Credit cards are worse for people who avoid structure. If you struggle with discipline, if you only pay minimums, if you hate seeing large monthly payments, credit cards will quietly drain you over time. They don't scream, they whisper, and they keep charging interest, month after month. Personal loans are worse for people who don't fix habits. If you treat a personal loan as a reset without changing spending, it becomes a temporary relief that creates long-term pressure. You're locked into a fixed payment whether your income goes up or down. There's also a credit score angle most people don't think about. Credit cards affect your credit utilization, which is a major factor in your score. High balances can lower your score quickly. Personal loans affect your credit differently. They don't impact utilization the same way, but they do add to your total debt and monthly obligations. Another difference is flexibility. Credit cards give you flexibility, but that flexibility comes at a cost. Personal loans give you predictability, but they reduce flexibility. Neither is good or bad on its own. The danger comes from using the wrong tool for the wrong problem. So let's simplify this. If you need short-term liquidity and you can pay it off quickly, a credit card can be fine. If you carry a balance long-term, a credit card is usually worse. If you need structure and a clear payoff timeline, a personal loan can be helpful, but only if you don't refill the credit cards afterward. Here's the practical takeaway, and this is important. The worst debt isn't the one with the highest interest rate. It's the one that stays with you the longest. Debt with no end date quietly becomes a lifestyle. Debt with structure forces resolution. Before choosing between a personal loan and a credit card, ask yourself one honest question. Do I need flexibility or do I need discipline? Your answer matters more than the interest rate. Understanding this difference can save you years of stress and thousands of dollars. And most people never learn it until it's too late.